Howdy, everybody. Welcome to the Liberty Call for January 10th, 2025. Hope you're having a fantastical Friday out there. It's pretty nice here in Colorado. The skies are clear. I cleared my driveway for the second time this week, which I always enjoy. I mean, it wasn't too bad. It was only like 2 or 3 inches. So I could mow through it pretty quick with the snowblower and then clear off the cars. So anyways, but yeah, it's slippery and cold outside. So hope your day is going much better. All right. Well, markets are down ahead of the December jobs report with NVIDIA and Tesla grabbing the headlines. Bank of America's bond losses are piling up. Home builder stocks are taking a hit from rising mortgage rates, and the UK is facing its highest borrowing costs since the 2008 crash. On the global front, wildfires in LA are causing record-breaking insured losses, with total economic damage nearing $50 billion. And I saw on TV, could be as high as $150 billion. We got a lot to cover. So before we do and dive into things, I need a favor from you. I need you to give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right, well, let's hop into today's markets. All right, Dow Jones finished the day down 1 2/3, 707 points, closed at 41,927. S&P 500 down 1.55%, 91 points, closed at 58,26. NASDAQ down 1.64, 318 points, closed at 19,160. The VIX was up 8.47% today. It's at 1960. Canada down 1.22, Brazil down 0.68, and Mexico down 0.34. Headed over to Europe, Germany was down 0.47, the UK down 0.86, France down 0.79, Netherlands down 0.62, Spain down 1.5, Italy down 0.64, Switzerland down 1.17, and Portugal down 1.53. Russian exchanges, MOEX up 1.77, the RTSI up 2.15. It's the first time in a while they haven't been the same. And the Asian markets, the Nikkei was down 1.04%, Australia down 0.42%, New Zealand down 0.58%. In China, the Shanghai was down 1 1/3, Shenzhen Component down 1.8%, China A50 down 1.03%, DJ Shanghai down 1.23%, Hang Seng down 0.92%, and the Taiwan weighted down 0.3%. A lot of down markets, just a rough day across the globe. All right, well, let's bring up our stock charts. And let's start out with the Dow Jones and see how it did for the week. Looks like it's going to be red by about 1.9%. S&P 500, it's going to be down about 2%. And the NASDAQ, it's going to be down about 2.4%. The Dow Utilities, let's grab Friday, and there we are, down about 3%. And the Dow Transports, it's going to finish the week also down, all of them, 0.6. So that was the best of everything going on. So let's zoom out and take a peek and see how things are doing the last couple of months. So here we have the uptrend that began really in August of last year on the Dow, and had a nice uptrend, and then it broke the trend, but still continued to keep that same less than aggressive pace, and but things really turned here at the beginning of December, and December's basic was all down, and it looks like we're forming a new trend line here, bouncing off of this every time we get to it. So also on the momentum indicator, we've crossed on the MACD. Let's see, let's go to the 3-day chart. It gives you a better look at it. Let's see here. The stochastic has already crossed down below the midpoint. The Wilder's relative strength indicator is now down to 43. But on a 3-day, the momentum indicator has still got some ways to go before we break the zero line. So, but on the histogram, we've already gone into where it's, flipped into the red, and then also on the money flow, it's also in the red. So right now, the Dow does not look very good. Let's go over to the S&P. We haven't really started to form up a real negative. Oh, let's go to the daily. A real negative trend line, and until that point comes, I'm not really sure where we're going. If this is sideways or what. And then same thing with the NASDAQ. It's not really shaping up into any real signals right now. So, all right, let's get that off the screen. All righty. Let's jump over to the economic data that came out this week. Starting out with initial jobless claims came in at 201,000. Forecast was 214. Previous number 211. Continuing claims came in at 1.867 million. Forecast was 1.87 million, so just 3,000 below forecast. Previous number was 1.834, so it went up a little bit. Factory orders month over month contracted at 0.4%. Forecast was a contraction of 0.3. Previous number was 0.5% growth. The U.S. trade balance came in at $78.2 trillion. Or is that billion? I forget. Maybe billion. Yeah, 78.2 billion. Forecast was 78.3, and the previous number was 73.6. The JOLTS report, we had 8.098 million jobs. Forecast was 7.73, so above forecast there. Previous number was 7.839. The ADP non-farm employment change was 122,000, below the 139 forecast. Previous number was 146. Non-farm payrolls grew by 256, and the forecast was 164,000. Previous number was 212. The unemployment rate came in at 4.1%. Forecast was 4.2. Previous number was 4.2. The U6 unemployment rate, which I really consider more of the actual unemployment rate, came in at 7.5. Previous number was 7.7. And lastly, the U.S. Michigan consumer sentiment came in at 73.2. Forecast was 74, same as last month. All right, so those are all the data that was out this week. I know we had a short, trading session with Thursday being off due to Jimmy Carter's funeral and all that good stuff. But anyways, all right, well, let's get to the market recap. U.S. stock slump as strong jobs report sends Treasury yields surging. U.S. stocks fell sharply on Friday as a stronger than expected jobs report fueled fears that the Federal Reserve may prolong its current pause on rate cuts. Treasury yields spiked in response, putting pressure on growth sectors like technology and intensifying concerns about a shaky start to 2025. Yeah, Treasury yields have been, the 10 years, it's at levels it hasn't been in I think almost 15 or 20 years. So it is relatively high. Especially based on current interest rates. And also they've lowered rates, and actually we'll get to this in a minute. They lowered rates, but the yield has actually gone up on the 10-year by 100 basis points. All right, the December jobs report revealed that non-farm payrolls increased by 256,000, surpassing expectations of 164 and exceeding November's downwardly revised 212,000. The unemployment rate also dropped to 4.1%, down from 4.2. The unexpectedly strong labor market data led analysts to suggest that the Fed is likely to keep interest rates steady in its upcoming meetings. According to Jeffries, if the Fed had to make a decision today, would most likely adopt to hold rates. The prospect of fewer rate cuts pushed Treasury yields even higher, with the 10-year climbing 8 basis points to 4.765%, its highest since November of 23. Analysts warned that if yields breach 5%, it could trigger renewed fears of slowing economic growth and lead to a sell-off in equities. Oh no. The tech sector took a hit as rising yields dampened growth prospects. NVIDIA and AMD led the decline in chip stocks, with AMD dropping further after Goldman Sachs downgraded the stock from buy to neutral, citing concerns over revenue growth. Looking ahead, fourth quarter earnings season kicks off next week with JP Morgan Chase, Wells Fargo, Goldman Sachs, and Citigroup set to report results on Wednesday. Meanwhile, Delta Airlines soared over 9% on strong Q4 earnings, and Walgreens Boots jumped 27% after delivering better than expected results and an upbeat annual forecast. All right. So it's not all terrible news out there, folks. Not all. All right, let's get into some data. The December employment report from First Trust, Mr. Robert Stein put this together. All right, the U.S. labor market ended 2024 on a strong note, with the job growth surpassing expectations, unemployment falling, and wages continuing to rise. Non-farm payrolls increased by 256,000 in December, if you can believe the data that comes out of the government. Significantly higher than the anticipated 165,000 core job growth, which excludes government, education, healthcare services, and leisure and hospitality sectors. Also rose by 100,000, more than doubling the average monthly gain seen through 2024. Additionally, civilian employment, which accounts for for small business startups, grew by 478,000 in December, pushing the unemployment rate down to 4.1% from 4.2. Remember, we just covered, First Trust is pretty good with their data. They're just going to call it like they see it. But it's probably higher than that. We covered the U6 just a minute ago. Average hourly earnings increased by 0.3 in December, contributing to a 3.9% annual rise in wages for last year. Total hours worked rose by 0.2% in December and 1% for the year, resulting in more purchasing power for American workers overall. Yeah, I feel richer already. However, this labor market strength presents challenges for the Federal Reserve's efforts to reduce inflation to its 2% target. Persistent growth suggests that monetary policy has not been tight enough to consistently curb inflation. As a result, investors should not expect additional rate cuts from the Fed in the near future. A notable issue is the divergence between payroll and civilian employment data. While payrolls have grown by 2.2 million over the past year, civilian employment has only increased by 500,000. This discrepancy may be tied to a surge in immigration, where workers use fake IDs, appear in payroll surveys, but avoid household employment surveys. Alternatively, it could indicate that payroll surveys have overestimated job growth, signaling a potential slowdown or even a contraction in employment in the months ahead. All right. So, like I said, the data, it's probably crap, but is what it is. So, all right. I got one last thing here. It's a audio. It was yesterday's Tom Woods show, episode 2590, Reagan's budget director, what Elon and Vivek should do. And his guest on Tom's show yesterday was David Stockman, who very bright guy, very smart, someone I really value his opinion on things. And also Tom is he's a doctor, he's a PhD. So this man is not stupid. So I've learned probably, more about libertarianism and Austrian economics and, all sorts of good stuff from him over the last almost decade at this point. So we're going to take a few minutes and listen to their conversation, and then we'll get to the weekend. Sound good? All right.
Woods here. It is episode 2590 of the Tom Woods Show. We have the great David Stockman with us today. He is a former director of the Office of Management and Budget under President Ronald Reagan, and he is one of a very, very small number of people whose knowledge of the federal budget is such that he can weigh in so effectively on this general question of budget cutting, particularly in this age of the so-called Department of Government Efficiency that is being overseen by Elon Musk and Vivek Ramaswamy. Well, if they really want to be serious about doing this and not just eliminating the oddball academic research project that cost the federal taxpayer $100,000, they got to get David Stockman on the phone, or I don't believe them. I don't believe them. They're not getting David Stockman on the phone. So David, you wrote a 106-page memo that I read every word of, in which you went through in great detail what would need to be done if you want to start getting an annual $2 trillion in savings on federal spending. And I guess the first thing I want to say to you is I have the definition of book gets smaller and smaller over time. I think this is quite publishable, especially under a provocative title, Blueprint for Doge, or something like that. By a man who saw it all under Ronald Reagan, something like that. Get it out as soon as possible, right? Why not?
Yeah, well, actually, as we're thinking along the same lines, I was actually working on an edit this morning with that exact project in mind. So we can talk about it later. But the idea was, I thought we do need $2 trillion of annual savings a few years down the road, not in the by and by, in 2050 or something like that. We need it by the end of Donald Trump's second term if you're going to cap this nightmarish eruption of the public debt, because now we're into a syndrome where the debt is increasing so rapidly that the interest cost increase each year is enormous. We crossed the $1 trillion mark. If you look at the early 30s, interest alone, given that we're going to have 60 trillion of public debt, will be, almost 2 trillion. And then, it goes skyward from there. So I think the reason I started with this is I do believe they need an A to Z blueprint. I do believe also they need a format or a structure that helps think through, how do you go about saving $2 trillion a year in this $7 trillion monster that we call the federal budget. Now, before I go into some of those details, which we have in this 106 pages, I think it's important to recognize how crucial this is, that it's not an academic exercise or some kind of ideological fetish? Wouldn't it be great to cut 2 trillion or bring the budget closer to balance? No, here's a number sequence that I think should wake up everyone, alert them that this is the most crucial thing that the next Trump administration can be doing. When I was in that job in 1981, the public debt was $930 billion. It was under $1 trillion. It had taken us, almost 200 years to get there. By the time Trump became president the first time, it was $20 trillion. When he becomes president this time, it will be pushing $37 trillion. By the time the current 10-year window for the budget, we look at the budget on a 10-year basis, and beyond that is pretty speculative. But for 10 years, you got a pretty good handle on it. It's likely to be pushing $70 trillion if you put in some realistic economic assumptions. And here's the point. By CDO's own long-range budget forecast, by the middle of the century, 2050, the federal debt will be $150 trillion. Now, I went through a couple of big numbers there pretty fast, but start with the 1 trillion when Reagan said that we've got to tame this thing, to the prospect of 150 trillion. And this isn't, in the next century or something like that. That's 25 years down the road. And in budget time, a lot of that's already baked in due to demographics and other things. So that's the magnitude of what we're up against. And so therefore, unless Elon Musk and Vivek can come through and really help steer the administration in the direction of this kind of blueprint that I laid out, it's going to be, a pretty grim time for the future of, democratic government and capitalist prosperity in America. So what I did was I said, okay, let's have a big picture notion. How do we get to 2 trillion? And let's pick a realistic target year that we can work towards very quickly, because you can't obviously do this overnight in year one. So I said, let's take fiscal year 29. That'll be the last Trump budget of his second term. And let's target for 2 trillion of savings in 2029. I divided it into 3 buckets. I said, slash the fat, and I laid out a plan how to get to 400 billion. And that's mainly by getting rid of agencies or downsizing them dramatically and reducing headcounts quite sharply, on average 40% in the non-defense part of the federal budget. But I said 400 billion from slashing the fat in a way that would shock Washington when they start to go through it agency by agency, cut by cut. That's only 20% of the target. And what I'm trying to do is sober people up to realize that even if you got rid of all of the nonsense, if you eliminated 40% of the bureaucrats outside of defense, and I'll get to that separately, you're only 20% of the way to the goal. So then my next bucket was downsize the muscle, and we're talking about national security and the defense budget, and in a way that's consistent with a true version of America First. And when I went through that, I said, basically, we could cut 500 billion out of a trillion plus national security budget by 2029 by reorganizing and refocusing all of our resources on what I call a Fortress America defense and a invincible strategic deterrent. But still, after we've done that much, 500 billion of muscle and 400 billion of fat, you're not even halfway to the goal. So what I laid out in the balance of this paper was we got to cut 1.1 trillion, the balance, out of the bone. And by the bone, I mean entitlement spending and mandatory programs, from A to Z. Now that lays out how you get there, and it takes a minimum. And I tried to be economical about words and verbiage. 106 pages, as you say, Tom, to go through each of those.
All right, we'll go ahead and stop that there. So basically, Mr. Stockman, wants to, from his first 2 things, to trim the fat, get 400 billion, or billion? Yeah, 400 billion, and then 500 billion from the military. And this is 5 years from now, or 4 years from now. So this isn't, something we're doing today. And then another 1.1 trillion out of just, the rest of the government. So, personally, I think this is the way to go. Something needs to be done because, unfortunately, like he said at the beginning of his talk, that by 2050 we could have $150 trillion in debt. Imagine what that's going to do to your purchasing power of the dollar if the dollar's still around by then. If the dollar dies, then I think the federal government collapses. And if the federal government collapses, then the dollar collapses. So it's a big mess we're in right now. We painted ourselves into a corner, and unfortunately, the people that we put in charge to help solve these problems, unfortunately, only care about themselves and helping out their friends. So, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All of your financial planning needs can be addressed there. So feel free to give me a buzz. Also, go and watch Mr. Woods' video. I linked his website link in the show notes, but you can also go to YouTube and look up Tom Woods. I think it's Tom Woods TV is his web or his channel on YouTube, and you can watch it in its entirety. It's about 55 minutes. I listen at this is 1 1/4 speed. So if you're listening to me right now at like 1 1/2, that probably sounded really fast. So I apologize. So, all right. Well, I hope everyone has a wonderful evening and a good weekend, and I'll talk to everyone next time. Adios.